Good morning. This is Riley Gregory from Athene, and I welcome you to the Annuity Basics webinar. Before we get started, a few housekeeping items to share. First, you will notice you are in listen-only mode, which means your microphones are muted for sound quality. Michaela Stanton, product marketing partner with Athene, will facilitate a live Q&A today. So please submit your questions throughout the presentation, and we will try to answer as many as possible. Lastly, today's webinar will be recorded. So thank you so much for joining. Today, we are joined by Heather Fitzpatrick, Director of Internal Sales, IMO with Athene. Welcome, Heather.
Thanks for having me, everybody. Today, we're going to go through some annuity basics, and really we're going to dive into what is an annuity. So an annuity is an insurance product that we typically are using for retirement planning. It's a contract between a client and an insurance company where a client makes a lump sum payment or a series of payments in return. The issuer agrees to provide your client with regular payments, either immediately or at some point in the future. Phase one is what we refer to as the accumulation phase. This is the period when a client pays into the annuity. During this phase, clients can make either a lump sum payment or a series of payments over time. The money they contribute grows on a tax-deferred basis, meaning they don't pay taxes on the earnings until they start receiving payments. This phase can last for several years, depending on when the client plans to start receiving that income. In phase two, the customer can start taking those payments in various ways. A customer can decide if they want to take it all at once, as needed, or systematically. Annuities have really become a hot topic for various reasons. Higher interest rates. The higher interest rates have made annuities more attractive because they can offer a better return compared to the low interest environment of the past decade. Market volatility. When the stock market experiences significant ups and downs, many people want to look for a stable and more predictable income source, which annuities can provide. Longevity concern. People are living longer. There's a growing need for financial products that can provide income for life, ensuring that your retirees don't outlive their earnings. And of course, pressure on Social Security. Concerns about the long-term sustainability of Social Security benefits have led to many seeking additional sources of guaranteed income. And last but not least, the tax advantages. Annuities offer tax-deferred growth, which can be appealing for those looking to manage their tax liabilities in retirement. These factors combined have increased the interest in annuities as a reliable component of retirement planning. Here at Athene, we work with financial professionals in 3 different channels: independent marketing organizations, or IMOs, broker-dealers, BD, and our financial institutions, otherwise known as banks. Financial professionals work within their channel and get appointed with Athene to be able to offer our products to their clients. So who could benefit from an annuity? There's a lot of people out there who could benefit, such as retirees seeking guaranteed income. If you have clients who are nearing or already in retirement and they want a reliable source of income to replace their paycheck, an annuity can provide those regular payments for them. What about individuals with longevity in their family? Customers that expect to live a long life and want to help ensure that they don't outlive their savings might benefit from an annuity that offers a lifetime income rider. Risk-averse clients. If you have clients that are uncomfortable with volatility of the stock market and prefer a more predictable income, fixed indexed annuities can offer a solution. People without other retirement income sources. If you have clients who have lacked significant income streams like Social Security or pension, annuity can help fill that gap. An immediate annuity is an insurance product designed to provide a steady stream of income within the first 12 months after a client makes a lump sum payment. Typically, a client with a lump sum payment will start taking income within a month of purchasing that annuity. Some benefits of an annuity are the guaranteed income, providing a predictable and stable income stream that can be structured to last for the client's lifetime. Once set up, it requires very little management, helping it make it easier to handle versus other options. Some considerations, though, are the lack of additional liquidity. it may be costly or not allowed to withdraw the principal. Additionally, fixed payments may not keep up with inflation unless the annuity has an inflation adjustment option, so there could be some inflation risk. Immediate annuities can be a great option for those looking for a reliable income source in retirement. Deferred annuities are a type of annuity that starts making payments at a future date, unlike immediate annuities, which begin payments within the first 12 months. With deferred annuities, your client can make a lump sum payment or a series of payments over time. The money grows tax deferred, meaning they don't pay those taxes on the earnings until they start receiving payments. There's also more flexibility, allowing clients to start receiving payments when they need them. With a deferred annuity, the payment timing can be different. The growth period has an accumulation phase where the value can grow, and the crediting options are different. Deferred annuities offer more crediting options. Deferred annuities can be a good option for clients that want to grow their retirement savings and start receiving payments later. Annuitization is the process of converting the value of an annuity into a series of periodic income payments. This is a crucial phase for those who have purchased annuities, as it determines how and when your client can receive their income. Annuitization provides a steady income stream, which can be particularly valuable during retirement. Payments can last for a lifetime, and they are low maintenance. Let's take a closer look at some of the things you may want to consider when looking at annuities for your clients. Annuities can be funded in two ways: either a single premium, which is when all funds are received at the same time the application is issued, or a flexible option. Some single premium contracts may be considered modified and allow additional premium within a specified time frame, for example, in the first year. With a flexible premium, the customer can add additional premium to their contracts over the life of the policy. For example, adding $500 per month to help grow that annuity. Most contracts have issue age requirements. Issue age guidelines are age requirements that a client must meet at the time the contract is issued. These can vary by product as well as by state. Each product, regardless of carrier, can have a rate card or guide that should be included with this information. Most annuities assess a charge if withdrawals are made during an initial withdrawal charge period. Each contract has a surrender period, which is a set of number of years which your client may face penalties for withdrawing more than a specified amount. A common range may be 5 to 15 years. If your client withdraws funds during that surrender period, they may incur surrender charges. These charges typically decrease over time. Annuities generally offer limited liquidity compared to other types of products. However, many do have some free withdrawal options. Many annuities allow for a certain percentage, often around 10%, of the accumulated value to be withdrawn each year without penalty. There are also typically additional provisions for when life happens. Some even offer waivers of surrender charges under very specific circumstances, such as terminal illness or confinement. Required minimum distributions are mandatory, minimal annual withdrawals that must be taken from certain tax-advantaged retirement accounts once the client reaches a specific age. Be sure to see if the annuity you're looking at for your client has provisions for RMDs that will not negatively impact your client. Non-qualified dollars used to fund an annuity simply means that the money used to purchase the annuity has already been taxed. Only the interest is taxable when funds are withdrawn. The principal amount, the client's original contribution, is not taxed again. RMDs are also not required, helping give the client more flexibility on when to take withdrawals. If the annuity is funded with qualified funds, these are pre-tax. This is usually done through retirement accounts like traditional IRAs and 401ks. Your customer hasn't paid taxes on the money yet, so when they withdraw funds, the entire amount, both contributions and earnings, are subject to income tax. Qualified annuities are subject to RMDs, meaning your client must start taking some distribution at an age determined by the IRS, currently 73. Some annuities allow for additional bonus to help the growth of the annuity. A couple of examples: premium bonus, which could be a lump sum applied to the account value. For example, if your client purchases an annuity with $100,000 and the company is offering a 5% premium bonus, their account value would immediately increase to $105,000. Persistency bonus is an incentive to encourage the annuity holder to keep their contracts for a longer period. They encourage stability and aim to reduce the likelihood of policyholders surrendering their annuities for other financial products. We also have an income base. Income base helps to enhance the income account value of an annuity. The income account value is used to calculate future income payments. So by applying a bonus to that account, it helps to increase the value and thereby increases the lifetime income payment. For example, if your client purchases an annuity with $100,000 and the company offers a 5% income-based bonus, that income account value becomes $105,000. You may have heard of the Guaranteed Minimum Withdrawal Benefit Rider as a GMWB, or income rider. This can help provide a safety net by ensuring your client can withdraw a set percentage of their account value annually, regardless of market performance. The benefits of having an income rider include market protection and flexibility. Some considerations might be that the fees as an income rider may come with additional fee, typically ranging from 0.5% to 1% per year. These can be a good option for those clients looking to help mitigate market volatility risk while ensuring a reliable income stream. Many annuities come with death benefits, which provide a payout to your client's beneficiaries if the owner and/or annuitant passes away before the annuity is fully paid out. Death benefits can help provide peace of mind knowing that the annuity can help support a client's loved ones, even after they're gone. Annuities come in different types to help meet different needs. One of the ways they vary is by the amount of potential risk and return as shown on this slide. The immediate annuity has the lowest amount of risk, whereas the variable annuity has some of the highest risk of loss. Fixed annuities offer a fixed rate for a specified period, providing predictable growth. These are ideal for conservative clients who prefer stability and guaranteed returns. FIAs are linked to the market and the performance of a specific market index, such as the S&P 500. They offer the potential for higher returns than a fixed annuity, while providing some protection against the market downturns. RILAs combine the features of fixed and variable annuities, offering returns based on a market index with a level of downside protection. These allow the customer to choose a level of risk and potential return, making it a flexible option for different investment strategies. While variable annuities allow the client to invest in a variety of subaccounts, similar to mutual funds. These have potential for higher returns, though the returns depend on performance of the chosen investment. This can lead to higher growth, but also comes with that higher risk. When a client purchases a fixed rate annuity, an interest rate is locked in for a specific period of time. This rate is guaranteed and does not change, providing predictable growth. Renewal rates on fixed rate annuities are the interest rate set by the insurance company at the end of the initial guaranteed period. This rate can be higher or lower than the initial rate depending on current market conditions and the insurer's performance portfolio. They may also have different terms than the initial premium. Many fixed annuities come with a guaranteed minimum interest rate, ensuring that even if the renewal rate is lower, it won't fall below a certain level. These are disclosed at the time of purchase. Renewal rates can significantly impact the long-term growth of an annuity, So it's wise to stay informed on how they work. The minimum guaranteed rate is fixed and guaranteed by the insurance company for the duration of the contract. Fixed indexed annuities are a type of annuity that offers a combination of growth potential and protection from market downturns. Here are some basics on FIAs. Contract lengths. FIAs typically have a contract term ranging from 5 to 10 years. During this period, a client's money can grow according to the terms of the annuity. The surrender period is the time during which a client may incur a penalty if funds are withdrawn. It usually matches the contract term. Initial interest rates are the rates at which the annuity grows initially. It's often guaranteed for the first year or the first few years of contract. There's the indexing method. FIAs credit indexed based on the performance of a specified market index. Again, examples, the S&P 500. However, they do not directly invest in the market. Renewal crediting rates. The renewal rates are what happens after the initial period. The interest rate may change. The renewal rate is determined by the insurance company and can vary annually. The minimum guaranteed rate on a fixed indexed annuity can vary depending on the specific product and the insurance company offering it. Generally, this rate helps ensure that the annuity can earn at least a small amount of interest even if the market index performs poorly. Fixed indexed annuities have provisions for interest crediting rates. These provisions determine how interest is credited to the annuity based on the performance of a specified market index. FIAs generally offer better potential for growth compared to fixed annuities. The interest credited to a FIA is linked to the performance of a market index, such as the S&P. This means if the index performs well, the clients have the potential to earn higher returns. While FIAs offer the potential for higher returns, they also include a minimum guaranteed rate to help protect against market downturns. And one of the key features with FIAs is the fact that while a client may receive zero in return, they will never receive less than zero, so no negative returns. Applicable charges, such as a rider charge, could exceed interest credited, which could result in the loss of principal. Custom indices offer several advantages that can make them appealing to clients. They allow your clients to have indices that include a mix of asset classes, such as equities, bonds, commodities, allowing a broader diversification compared to some of the traditional indices like the S&P. This helps spread risk and potentially help returns. Many custom indices have built-in volatility control mechanisms. These features adjust the index exposure to different assets based on market conditions, aiming to provide a smoother, better return and reduce the impact of market inflation. They oftentimes have higher participation rates, meaning a greater percentage of the index gains are credited to the annuity, and this can lead to potentially higher returns compared to some of those standard indices. By including multiple custom indices that are not highly correlated, clients can achieve more stable and sustainable growth. When one index underperforms, the other might perform really well, balancing the overall performance. Imagine a FIA that includes two custom indices, one focused on U.S. equities and another on global bonds. If U.S. equities experience high volatility, and the global bonds might have provided that more stability, resulting in that balanced overall return. Custom indices can be a powerful tool within FIAs, offering a blend of growth potential and risk management tailored to the needs of your retirement saver. Fixed indexed annuities credit interest based on the performance of a specified market index, such as S&P 500. If you take a look at this image, you can see the blue jagged line, which is the market itself. You can see that if the client's money was allocated to that, they would have gains, but you'd also see the downside years where the market is going down. However, let's look at years 1 and 2. Here you can see the market was down. Had your client invested $100,000, they would have lost nearly half of that, coming in closer to $50,000 after year 1. However, if they were in a FIA, they would still have their $100,000 because they did not have a negative return. Now you can see as you look at years 13 and 14 where the market was on a roll, and you can see that. While clients did see gain, they didn't partake in all of that gain because they were in a fiat and only got a percentage of the growth. Some clients like knowing that each crediting anniversary, they're locking in whatever gains they had for that time period. Once those gains are locked in, they can never lose those due to market changes. Cap rates are the maximum interest rate that can be credited to an annuity. For example, if the cap rate is 5% and the index credits 3, your client will get 3. If index credits 5, your client will get the full 5. However, if the index credits 9, your client will get the 5 as their cap has been met. Spreads allow for a percentage subtracted from the index gain before interest is credited. So if the spread is 2% and the index credits 3, your client will have a 1% gain. If the index is up 5 and we remove the spread of 2, your client has a gain of 3. If the index is up 9 and we remove the 2% spread, they get 7. Participation rate is that of the index gain that is credited to an annuity. So if we look at that one, if the participation rate is 50% and the index gains 3, your client annuity would be credited with 1.5%. If the participation rate is 50% and the index gains 5, your client's annuity would be credited with 2.5. If the participation rate is 50% and the index gains 9, your client's annuity would be credited with 4.5%. To wrap this up, I want to leave you with 3 things. Annuities are an insurance contract. Clients insure many things from home to health to cars. Annuities can help protect one of their biggest assets, their savings. They allow for protection, growth, and income. Based on your client's risk tolerance and financial needs, fixed indexed annuities vary in risk and returns while still providing a lower risk than many other financial vehicles available. Annuities can help your clients if they're concerned about having enough money to get through retirement. One might be right if they want to help protect their retirement income from downside risk, or they'd like a lifetime income stream, or maybe a way to leave a little more to their beneficiaries. Both types of annuities can be valuable tools for retirement planning, depending on your client's financial goals and risk tolerances. I believe that opens us up to Q&A.